Do you hate the thought of working past 55 or 60? Do you hate not being able to live the life you deserve today? Do you hate not knowing what your financial future looks like? It's time to stop doing what you hate. Here's your host, Mr. Harold Green.
Hello, everybody. This is Harold Green of Bright Tree Wealth Management, and it is time to stop doing what you hate. Hopefully, you folks are having a fantastic day, doing pretty well. Just, we're off to a rough start this year, but I think we're recuperating and getting better. We got our strategy in place, and that's the most important thing. And today's show is going to be an interesting show because it's going to be I would say a compilation of a lot of different market minutes that I put together. And how I normally do the market minutes is I study the market, and then I just kind of tell my clients basically what we're doing, how our positions are holding up against the backdrop of the things that are happening in the market. And the most important thing is, no matter what happens, you must have a strategy in place, or be working with somebody that has a strategy in place for you. Because when all hell breaks loose and people start running around like chickens with their head cut off, you can panic as well. And today I want to talk to you about how we take advantage of all the chaos and how we use the chaos machine to generate wealth for our clients. But, before I get into it, I want to talk to you a little bit about my week. And I always like doing this because I'm a real person and I go through things just like everybody else. I've had people tell me, we don't even know how you do what you do with all the things that you have to handle and everything that's on your plate. And I've shared my faith a lot about how I believe in the Lord, and how, basically when stuff goes down, I just simply sit down with him and just say, yo, check this out. Like, how do I deal with this? This is tough. This is hard. It doesn't make sense. I can't figure it out. Something's wrong here. What do I need to do? What is my role in this right now? Like, what am I supposed to be doing right now? And one of the things he shared with me was, when you're in a situation like this, you always have to remind yourself to take care of yourself. Literally take care of yourself. And I don't want to get into it, but it was some pretty difficult things. And it could have been a life altering decision that I had to make. And I had to make the right decision. And if I made the wrong decision, not only would I hurt myself, but I would hurt all the clients that work with me. It could have been disastrous. And so I prayed about it. And as I was making my decisions, I had to take care of myself. I was in the gym as much as I could, training, doing the things I needed to do, and just focusing on making sure that I was okay. Because when you need to make life-altering decisions, you need to make sure that your mind is in the right place, because your emotions can get the best of you, and you're making emotions or decisions purely based on emotion, speculation, or whatever, out of a twisted mind, because you're just not in the right place mentally. So I think I'm doing okay. I think I made the right choice. I think time will tell, but I do believe that I made the right choice. That's all I can say about that. And so I want to get into today's show, using chaos to make money. Are you ready? 1, 2, 3. Let's get it. Now, this is an investment show. Investments do carry risk of loss. Past performance is no indicator of future results. If you're going to invest in the market, you better do your due diligence, understand your risk tolerance, understand your time horizons, and make sure that you are putting together a well-balanced, comprehensive financial plan, and then your trading strategy is around that well-balanced, comprehensive financial plan. And no, we're not talking about Pokemon cards. Look, man, there's all kind of fads out there and all kind of crazes that will come along. We had Bitcoin, we had Ethereum, we had all these Ripple, I don't know, Cripple, Triple Ripple, I don't know. There's all kinds of things that come out. And one of the things, I was talking to a young client yesterday, and we was having fun with it. And the dad, I called the dad because we had to take care of some business, but the son's also a client, and young man. And so we're talking, and the dad said, "Hey, I got so-and-so here. Talk to him for a couple of seconds because he needed to hear something." And so we started talking. He said, "Guess what he's doing? He's buying Pokemon cards." And I said, "Yeah, that's cool, but that's not his long-term strategy." And I said, "Purely treat that as entertainment. Treat it as money that you take to Vegas and throw in a slot machine or blackjack, whatever you're going to play, and just treat it as entertainment. It can be fun. So set aside some money that you want to play around with that and enjoy it, you know, but it's not your entire financial plan. Same thing with Bitcoin and stuff like that. Yeah, do some of that stuff. Have fun with it. Treat it as entertainment, right? Because there can be an entertainment value in investing in anything, whether it be classic cars, precious metals, whatever it might be. But that is not your long-term comprehensive financial plan or strategy. And so, when we start getting into what drives chaos in the stock market, this is very important that you understand this. And if you are a client, it's also very important that you understand this. If you are a potential client, it is super important that you understand this, because nobody is going to tell you the stuff that I'm telling you guys right now. Most likely nobody, unless it's somebody who thinks like I do. And I think I'm just some weirdo. I have weird ideas, but they work, and they're weird because they go against the grain of what you're being told out there. And what drives chaos in the stock market is a variety of different things. And the stock market is supposed to be efficient, but it's not. It is not efficient. It is violent. It's a form of psychological warfare. It can kill you mentally, physically, emotionally, financially. And many people have lost millions and gazillions and billions of dollars in the market because they didn't have any kind of strategy. They didn't understand what the kind of chaos that they were dealing with. So I'm going to just kind of go through my list today and talk to you about how I position my clients when chaos erupts. And it's going to be very simple. The average investor, they have one or two mindsets. Either they're long term and they take the chaos like, say, water rolling off of a duck's back, or it's life altering, life changing for them, and they go into a conniption and they melt down. It's only two types of people. And you have to understand what type you are if you're ever going to have any kind of significant wealth derived from the stock market. And if you're the type of person that has a conniption every time the market goes down, and you think that the market should only go up, and that's your new base, like your new basis. So you give me $1 million and we make 500,000 in 3 months. Cool. But then you're like, hey, okay, boom, I made 500,000. I'm good. Like that shouldn't go down. No, we didn't take any profits. That's going to stay right there. But then as soon as you lose 100,000, you're tripping. You're like, oh my God, you just lost me $100,000. No, I didn't lose you anything. We made 500,000. The market went down. Your portfolio went down by 100,000. You're still up 400,000 and your basis is $1 million. Okay. You need to look at it like that. If you're not going to take the profits when the market goes up, then you sure as heck shouldn't be complaining when it goes down. And a lot of times it's all about greed. Some people get greedy. And I did a show just recently called, titled Greed versus Optimism. But I want to talk about, I don't know, maybe about 10, 15, maybe 10 things here that I consider chaos to the markets. They shouldn't be, but they are. And I am not an economist. I didn't go to college for economics. My college education was information technology. And I didn't even finish that. As the rule says, I have to tell you folks, I do not have a formal college degree, but I am a fiduciary advisor and I've passed all my licenses and all my tests and I maintain all my compliance stuff. So I'm legit, according to FINRA and the SEC. That's all that matters. All right. So Fed meetings. That's when the Federal Reserve, they come out and they got a chairman and basically they set interest rate monetary policy in the United States. If they feel the economy is running hot, they raise interest rates to cool the economy down. They say the cure for higher prices are higher prices. It's like fighting fire with fire, that kind of thing where you have a fire and then you set a fire opposite of the fire to kind of suck the energy out of that fire and burn it out, that kind of thing. So if you guys go study forestry and burning and stuff like that, you'll understand that. So the Fed is not supposed to be political at all. They're not supposed to be talking about politics. Their rates that they set are not supposed to be political. It's all supposed to be strictly monetary. Okay. So when the Fed comes out and they say they're going to strike a hawkish tone or they're going to strike a dovish tone. If they go hawkish and they say something like, well, we got to keep an eye on inflation and inflation is not yet dead. And we feel that monetary policy is restrictive enough and we need to give it time to see, to see how it works and da 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 da. Like to me, like they should know how it works. But what the dark horse is not monetary policy, it's fiscal policy by the government. The more money that the government spends, right, the hotter inflation can go. So the Fed comes out, we had one administration spending a gazillion dollars. Everybody in their right mind told them that was going to be inflationary, but they did it anyway. They did it anyway. And the Fed said, okay, yeah, we're going to have a little inflation, but it's transitory. It'll go away real quick. It was one of the worst periods in the history of the United States from an economical standpoint when it came to the interest rates. They had to hike interest rates a gazillion times because they were behind the curve. Now, again, I'm not an economist. I don't work in the Fed. I'm simply stating what happened. Why it happened, I don't know. I wasn't in meetings. Okay. But it caused chaos in the market. You had nowhere to run. I mean, nowhere, like nothing, unless you were sitting in cash. Okay. Now, you could have been sitting in cash and then waiting for the market to come back up, or you could have been buying this massive 1.5 year dip in everything. Okay. So what were we doing? We were buying the dip, selling positions, rotating positions, and then loading up on options because to me, this was going to go away at some point. I knew at some point you were going to get a different administration because of how bad things were being handled. When you start looking at the Fed having to come out and hike rates, and now they're talking about they're going to, go cautious. This is in December of last year. They're talking about being cautious and different things like that. They came out very hawkish. I mean, and I think it was the last rate cut. I think they did the 25 basis points and came out and said, we're going to wait and see what happens, right? And then next thing you start getting all these Feds coming out and saying, hey, we think inflation, it's on the way down, but it's not going down fast enough. So, we're afraid of tariffs. They didn't say that, but they brought the word up. Okay. Now, if the Fed's not supposed to be political, what the hell are they doing talking about tariffs? And tariffs, driving in. What are they doing talking about? That's fiscal policy. Monetary policy is their thing. And to me, I feel that that's something they should not have said. That spooked the market. Then you start getting all the reports coming out about tariffs and different things like that. And it made everybody go crazy. And then you started talking about, the Fed may have to cut rates or raise rates. Now, I study charts and I study history. And I put together a phenomenal inflation chart, bond yield chart, and in Federal Reserve rate chart. And it just kind of shows me the history of what the Fed was doing, what rates were, and what inflation was. And at no time did I see in this chart from 2007 that the Feds had to raise rates when inflation went back up. In fact, inflation did go back up, but the Fed was still cutting rates because the economy was so bad. They had to, or else we're just going to go into a crash and not recover from it. So I knew that when the media started saying stupid stuff like that just to drive a narrative, look, whenever the market takes those dips, it's time to load up because that's raising rates is not in the cards. I'm not saying it's impossible. I'm saying based on their history and this data that's being manipulated, that's another thing I'm going to get into and being spun a certain way that causes chaos. So moving along 2025, we get the PPI report. That's heading down. Then we get the CPI report. That's heading down. And then you get the Fed come out and say, whoa, maybe we can cut rates 4 times this year. And it's like, what? Now, forgive me, because last year they had already projected they were going to cut rates 4 times this year. And then for them to come out and say, we're going to be cautious and we're going to wait and see. Wait a minute. What changed? The only thing changed was the election. Biden didn't win, Trump won. And then the tariff talk came in. Then you started having this hawkish stuff come out. Then you had the report from the Department of Labor recently about the jobs created in December. Now, this is another thing that's chaotic. In December, there's a lot of seasonal hiring. A lot of people have 2 and 3 jobs. They're not only counting full-time jobs, they're also counting part-time jobs, from what I understand. And the seasonal jobs, they're seasonal. They're not going to be there forever. Okay. So, so that threw the market off. And a lot of the jobs that were created by the government last year, or governments, or jobs that are funded by taxpayers. These are not regular jobs like corporate jobs. These are, majority of them were jobs funded by the taxpayer. Okay. So when you get reports like this, and it's like, yeah, then the economy is great. Well, the economy is not creating these jobs, the government is. That's a false report. To me, that's false narratives right there. And all the economists know this. And some of the honest ones, they'll come out and say it on TV. They'll come out and say, hey, yeah, these are government jobs, or these are retail jobs, or these are low paying jobs. These low paying jobs is not going to smoke the economy. Okay. People are with these low paying jobs are trying to stay alive. But this causes chaos and the algorithm goes crazy. And then we get the jobless claims. And if jobless claims go down, the economy is great. People got jobs, right? But some of these people are taking these low paying jobs. And then because they can't make it on unemployment and people still want to fight, this causes chaos in the market. Then we get the job openings report. We got 8 million jobs or 11 million jobs or 10 million jobs. The jobs are open, but the employers are afraid to hire because they're not sure what's going to happen. So I would say those jobs ought to come off the table. Okay. That's what I say. If you're not going to hire people anyway because you don't have money, but that causes chaos in the market and it drives the market insane. We talked about the labor reports, jobs revisions. That's insane. They'll come out and they'll revise the report. If they revise the report downward, that doesn't look good. Okay. Then the economy doesn't look that strong. And then it gives credence to the Fed to cut rates even more. So you see how you have all of these different things, factors creating chaos in the market. And then you have the consumer sentiment and the consumer confidence reports. And then you have the consumer inflation expectation reports. And then you get the PPI, you get the CPI, and then you get geopolitical issues that are happening around the world. That causes chaos. And then you get the Feds coming out and saying one thing or the other. That causes chaos. What is your strategy to handle the chaos? Okay. Are you focused on protecting from the downside, or you're taking advantage of the chaos and waiting for the rip back up to the upside until the news cycle changes? In this kind of market, I'm not looking to protect to the downside unless that's that particular type of portfolio and it's set for a conservative situation where the client is in the short-term bucket. Then yeah, we could be spread around. It depends on the risk tolerance and different things like that. But if we're in what I call a Brinks truck moment, and I view chaos as a Brinks truck moment, and what do I mean by that? The Brinks truck, Loomis or whatever you guys have, it crashes in the road and somehow it explodes open, bags of money all over the street, just like bags of money. And for some reason, the cops say, okay, whoever's standing by, go get as much of this money as you possibly can. You're not going to get caught. You're not going to go to jail. We're not going to punish you. This is a one-time thing. You got 15 minutes. And the question is, are you going to try to grab as much of that money as you can, or are you going to just stand by and watch everybody else scoop it up? Chaos in the stock market will provide you Brinks truck moments if you are picking the right stocks or the right options and you have the right risk tolerance and your numbers have to make sense. They have to make sense. Your research has to make sense. And you have to understand what's happening right here, right now. Is this going to be a long-term trend, or is this just a chaotic moment in time? Let's give you an example. NVIDIA, awesome explosive revenue, policy restrictions. We're going to curb chips to other countries so that China can't get them. What does that do? Drives NVIDIA back down from $155 a share down to $130 something a share. Chaos by the administration. Chaos. Now, do not get me wrong. I understand national security interest and different things like that. Okay. I understand all of that. I'm not saying they should or should not have done that. That's not my role. I'm simply stating what happened caused chaos. And we're looking at taking advantage of the chaos to our benefit. So what did I do? Waited a day or two, check my numbers. Has anything changed with the momentum of NVIDIA? Yes, it's trending sideways for a while. Has anything changed with the fundamentals of NVIDIA? Nope. Has anything changed with the theme that's driving NVIDIA, pushing revenues to all-time highs? No. Is anything going to change in the future? Probably not. Now, China's already getting chips from NVIDIA. NVIDIA already creates chips for China. This information probably will put a small dent in NVIDIA's revenue, if any at all, and it's temporary. The new administration may come in and say, what are you guys talking about? We can use other means to make sure China doesn't do anything crazy, even if they get the chips. There's other things we can do. So each one is going to handle it differently. So I said, okay, they drove NVIDIA down. That was a chance for me to buy more of the options for 2027. I already know what my target price is on NVIDIA. I see it for the next 12 months is one number. They were trading below the low target price for the next 12 months. We're already down here in the doghouse right now. Can it get worse? Yes, it can get worse. But what is the probability? What are the odds of it getting worse than it is? And if it does get worse, how fast can we recover? That's how I look at it. So yeah, we bought a bunch more options on NVIDIA, along with some of the other companies. Okay. And the other thing I want to talk about is algo trading on news. And this is the last thing I'm going to say, or one of the last things I'm going to say about this. So we had this thing out in NVIDIA, the CES, and out in Las Vegas, the CES. And the president of NVIDIA came out and he was doing a show and saying all the things that he says about what they're doing. And he drops a bombshell statement. He says, quantum computing is not going to be anything special for 30 years. And what happened? The algos killed the quantum stocks. I mean, some of these guys were down like 50% in a day. It was stupid. Mad stupid. And I said, let me take a look at these guys again, because I have them on my radar. I'm in and out of these things. Okay. So I found one, IonQ, and it was down bad. Rigetti was down bad. So I went in, I scooped it. I scooped IonQ, and I think within a couple of days, we're up 58% in that option. 58%. I'm probably going to sell out of it next week, but 58% ain't bad for one trade. And because it was all chaos. And again, when the algos start to exacerbate a trade to the upside or the downside, you got to look at what happened here. Is it a news cycle that is trading off of? Because news cycles will change as long as it's not a trend to the downside. That's going to be, and then it has negative headwinds pushing it, like say a company like a SMCI. That's another one that it was very chaotic. And I went in and I bought I had SMCI options. I got smashed. I rotated into other SMCI options and not a bad trade. I'm up 36%. And I bought a lot. I bought a lot of the SMCI 116 2026, $3 call option. Okay. Here's what this means. If SMCI clears all these hurdles, okay, and I'm sitting on 28 contracts, okay, 28 contracts times 100 is 2,800. If not NVIDIA, but if SMCI explodes, I have the right to buy SMCI on or before January 16, 2026 for $3 a share. $3. That's insane. $3. Or I can sell the option back to the market. And my cost basis in that position, the price I paid was $28,000. And I'm already up 36%. I'm sorry, I paid $58,000. And I'm already up 36%, which is pretty cool. So I'm going to continue to ride that because I have until January of next year. Now, I do have some losers on SMCI that also expire January 16, 2026 for a lot more. But I believe they are going to clear the hurdle because there's too much SMCI sitting in all of these mutual funds and things like that. It's a weight in the mutual funds and they haven't sold it out yet. And so I'm looking forward to that. And then I did something even crazier. I bought the SMCI 115 2027 $40 call option, and I paid about 100K for that. I'm down 35%, but I have until 2027. So if SMCI doesn't crack up, I'll be good. And normally when companies do things like this, they go through these cycles and they get themselves fixed because SMCI is kind of light years ahead of all the other server rack makers or whatever. And they still have great customers and so on and so forth. And data center build out is not going anywhere anytime soon. Like they're still going to be doing this. So are those risky moves? For me, yes and no. Not really. But would I make the same moves for clients? I would do a little bit of that based on their risk tolerance and their time horizon and different things like that, based on the overall goals of that client's particular portfolio. If they're sitting on $4 or $5 million in the portfolio and they've given me the green light to trade their portfolio like I trade mine and they have the appropriate risk tolerance, yeah, all day, all day. We're doing it all day, because it's a small portion of their portfolio. And if it does turn around the way it needs to, and we have the right runway or length of time in the option, we'll be absolutely fine. So what I wanted to share with you today is understanding that chaotic moments that drive the market down, these are not life-ending destroyers to your portfolio. It's only life-altering and destroying if you sell at the wrong time. And we look at the CNN Fear and Greed Index all the time. And when people are in extreme fear, that gives me confidence that the madness will be over soon. Okay. And as I was telling my clients in my market minute about a week and a half ago, I said, look, within 2 weeks, things will change. The news cycles will change. The information will change. We're going to get information that says contrary in a good way to what we've been hearing. And so just hang in there. Okay. Chill out. It'll be all right. We got it. We know what we're doing. Let us just make the adjustments and fly the plane the way we need to fly the plane. So I just wanted to share this with you because if you're having your money managed and they're not taking advantage of the chaos and they're running away from the chaos, then that doesn't bode well for your portfolio. And I had a client come over to me. I can't say their name, but they came over to me out of, they were referred by somebody. And when they came on board, they were transferring monies over to me, and the people that they were transferring from lied to them. And they stopped transferring all of the accounts over because the client was lied to. And the client said, I'm moving because I like the strategy over at this firm, and they're very diligent about their strategy. And the advisor on the other side said, well, we can do that too. And then they came back and said, no, we can't do that. I know for a fact they can't do that. And I told the client they can't do that because that's just not how that company works. They're not allowed to do that. Okay. So they felt bad about it. And then the next thing you know, we're up so big in the next, 2 or 3 months or so. The client was like, you know what? I'm just going to give you everything. So we moved almost everything. We still have a couple of things out there that we need to move over, all because of the strategy that we run versus the strategy that they run. And one of the accounts that the client is bringing over, they've been in this account for, a year or two, maybe 3 in these positions, and I've reviewed them. The client is down $4,000. I think it was out of $300 some thousand. They're down $4,000 over the last 18 months. Even if the client was in an S&P fund, they would be up like 20%. This goes to show you that not all firms are the same. And the other thing I want to address is I'm okay in retirement. I think I'll be okay in retirement. I think I'll be okay. Do you want to think you're going to be okay in retirement? Or do you want to have a higher probability of knowing that your plan says you're going to be fine in retirement? It's one thing to think you're fine, but it's another thing to have a well-balanced, comprehensive plan that says, yep, you can travel. Yep, you can redo the house. Yep, you can send the kids to college. Yep, you can pay for your health care. Yep, you can afford gas even if it's $10 a gallon. Yep. And if you don't have that, you might want to get on my calendar by calling Beverly, our client concierge. and letting her talk to you a little bit about what it is that we do. And then from there, if you like it, you like what you hear, you like what you see, what we'll do is we'll put together, and you give us all your data, we'll build out a mock financial plan, and I'll do that for free. And then I will send you a video, a personalized video explaining what I'm doing in your financial plan, okay? What it's gonna look like. And then you can take your time and decide whether or not you wanna work with me or not. But to simply discount me and say, charge is too much. 2%, you shouldn't pay no more than 1. I can get 10, 15% in an S&P fund, and that's all I'm gonna need. I'm good. And I'm gonna tell you, you're good until you're not. So thanks again for tuning in to the show. Our number at the office is area code 808-521-4401. And let me hear from you. Seriously. Thanks for tuning in to the show. Until next time, everybody, 1, 2, 3, let's get it.
This is the podcastfactory.com.